Keith McCullough, and welcome back to another real conversation. I've been quite looking forward to this one. It's my pleasure and privilege to welcome Annie Duke, who's the author of not only Thinking in Bets, which was one of my favorite books at the time, and then you one-upped me and you gave me almost like a textbook to help teach people, or at least help try to teach what you teach. So thanks for writing How to Decide. That's subject matter that a lot of people that watch HedgeyeTV or follow my process are quite aware of. So thanks for making some time for us.
Thanks for having me. I'm glad we could make it work.
It's cool. I mean, we were just talking offline about, okay, like how many kinds of crazies in the hedge fund business or, markets and finance do you actually talk to? And you rattled off like a very wide spectrum. That's interesting, Annie, because we actually have a very wide spectrum too. We can have anyone from, a day trader, somebody who's just whipping around in options, to a family office, to obviously a large hedge fund or pension fund for that matter. So maybe just start with that, like the kinds of people that you've really started to appeal to.
Well, I think the thing is that the work that I do, which is decision making under uncertainty, people I think they just kind of relate to it, right? No matter what they're doing, but everybody's trying to address different types of uncertainty, but in terms of what I talk about, it doesn't matter whether you're fast cycle, like something like options trading, where that's cycling very quickly, or like the slowest capital that you could imagine, which would be, say, like seed or angel stage venture, where that's going to be really, really long time horizon. I think that no matter which end of that spectrum you're on, you're feeling the effects of hidden information. You're feeling the effects of intervention, of luck. And I think that when you're over on the seed or angel side spectrum, you're really particularly feeling the effects of hidden information, because obviously you don't know very much about the company at that time. And I think that when you're over on the option side of the world, you're probably feeling a little bit more, obviously volatility and luck and the fact that the world is stochastic and trying to deal with that. But in both ends, obviously there's a dual influence, and you want to try to figure out how to create the best process given the amount of uncertainty there is. Then I also end up working actually quite a bit on the advisor side, because I think that advisors really struggle with how do they get clients to behave in what would be their sort of stated long-term best interest as far as their own finances are concerned. And we know that when people state what their long-term interest is, that they don't necessarily make choices in the short run that would comport with what their long-term interests are. And I think that's something that advisors really, really struggle with. And so I actually end up working on that side of the world as well quite a bit.
Yeah, in my world, process, that's all that I really want to improve. And it takes, at the same time trying to improve my process and trying to coach it. The second part of that is very difficult, because I'm just basically trying to explain what it is that I'm doing. If I was anywhere close to my former self as an athlete, it would be hard to do as well. Like how did I actually shoot that puck? I don't even really know. I mean, so sometimes, and that's been my challenge, and your books have really given me an avenue, an explicit set of avenues rather, where I can just kind of get into some of these topics like resulting and really like what you said. Let's just start with that. Stochastics. A lot of people in my world don't think stochastically. They think on a linear basis. They think deterministically. Can you start with something like that where I struggle with explaining the difference, but I do think that there's an 80-20 rule there where I think 80% of people think deterministically and on a linear basis, and I don't.
Yeah, and I think what goes along with that is that the majority of people have a high need for closure as well, and I think these things go hand in hand. So, like, what does a high need for closure mean? It means that you want to be able to close the loop and know for sure why something happened. And you're going to get there much more easily if you sort of sense the world as a deterministic place. In other words, that if I get a bad outcome, it has to have come from a bad process because that outcome was destined, right? It was when I made the decision, at the moment that I made the decision, the outcome I was going to get was determined. And if that's the outcome that I had to have gotten, then obviously the process must have been poor that got me there. So that's a more deterministic way to think about the world, but also you can see how that satisfies that need for closure, because then you know for sure, right? You can just work backwards in a way that allows you to sort of close that loop pretty simply. But it's not the way the world works. So, I mean, the thing is that when you make a decision, what you're setting in place is not the particular outcome that you happen to observe, but a set of possible outcomes. Each of those outcomes has some payoff associated with it, and some probability of occurring. And obviously, you can create some broad groups. You can divide it into the upside and downside, or you can get even more granular and talk about the tails. And obviously, one of the things that you always want to think about is how are you managing tail risk, for example. And so that's a place where you want to get more granular in the way you think about the set of outcomes. But when you're doing something like managing tail risk, what you're saying is that I don't think that that's going to realize most of the time. In fact, I think it's going to realize a very small percentage of the time. Mm-hmm. But I understand that when that does realize, the impact is so great that I should want to figure out a strategy in order to blunt the effect if I were to realize the downside, if the tail actually realized. But what that means is that you have to be comfortable with the fact that it's only going to occur some small percentage of the time. You may actually never observe it. And that most of the time, whatever you're doing to try to manage that, it's going to feel like it was unnecessary, because you have to take a step back and think about it as an expectancy problem. What's my expected value? What are the set of possible outcomes? And I have to imagine any of those routes being able to occur. Now, that's the way that obviously you would think about it going forward. But then we need to loop back and say, if we do observe the tail, we are neither brilliant nor not brilliant based just on that, right? It would, right? So we could have put a hedge on, for example, and then it realizes and we think we're really brilliant. But actually, it could be the case that hedge was actually quite a poor choice, right? We could have drastically overestimated the chances that the tail was going to, that we were going to observe the tail, or drastically underestimated it. And we don't actually know just because we happen to have observed it. And I think that's just a really hard way for people to think, but it's how the world actually works. And it's very hard to be a great decision maker unless you sort of step back and get really comfortable with that uncertainty.
Yeah, that's awesome. I mean, in explaining the difference. And it's a big difference because, especially when you get onto Wall Street. And this is why I thought that your book, Thinking in Bets, made it a lot more appropriate as a practical matter. Because betting incrementally, if you're making a negative bet and betting on a tail risk event, using put spreads and weighing your bets incrementally and probability weighting those bets as incremental information like cards start to hit the table, to me, that's exactly what I do. But you have Wall Street on the other side of this that a lot of people don't do what I do, to be clear. And the brilliance factor, the intellectual quotient is very high. So knowing why is what I often fight on my audience on. I'm like, you don't have to know why. You don't have to be the most brilliant person in the room. You just have to pay attention. And to me, like, hopefully this isn't just you and I agreeing on these types of things, but I think you agree with that. Do you think that it's endemic to my business, Wall Street, and all these super duper smart people, that they have to feel like the smartest player in the room all the time?
Oh, I don't think it's endemic to that at all. I think it's just endemic. Full stop. Put a period at the end of that. So I'll tell you I'll tell you a similar, I think something that maps pretty closely onto that. So I'm guessing that a lot of your listeners are familiar with super forecasting. Yep. Which Phil Tellock wrote. Totally brilliant guy. I collaborate with him. And what super forecasting is about is really kind of understanding how do you think about what the possible futures might be and actually be a better forecaster of those things. Now, prior to writing for Super Forecasters, he actually has an amazing book that anybody who wants to be a better investor should read, which is called Expert Political Judgment, which I know sounds weird that I'm saying people in finance should be reading this book. But this might be one of the most helpful books you can read. And essentially what he says is that expertise, like really deep subject matter expertise, is a double-edged sword. That obviously when you have that kind of expertise, your ability to sort of put the pieces together and understand why goes up. Mm-hmm. But what also goes with that is that you're less likely to update your model given new information that comes along. So we could think about, like, you have some very strong model of the world. one of the things he talks about, for example, is people who are experts in Cold War relationships between the Cold War relationship between the U.S. and the USSR. Okay, and so this is their model of the way that those two countries actually interact with each other. Mm-hmm. And so you have this very, very strong model, and then new information is coming in that tells you, if you did not have that strong model, you might say, oh, I should really update my model because something is really significantly changing in the world that's making it so that if I were to predict, given the old model, I would actually be wrong. And so I want to alter my model to go with this new information that's coming my way. But what ends up actually happening is that like that expertise that they have has caused them to dig a trench, right? Like all the years of experience and all the knowledge that they're building on top of it is getting them basically digging a deeper and deeper hole. And so that what happens is when new information comes their way that tells them that they ought to change their view of the world, they actually essentially like pull that information down into their model. In other words, they incorporate it into their model, or they reject it as an outlier, or they rationalize it so that they can protect the model that they have. And basically what you found, like with the Cold War, was that when perestroika started happening, they actually were quite bad at predicting what was going to happen right at the end there. Mm-hmm. Right before the wall fell, because nothing that was happening really fit in with their model of the USSR. So we can see this all the time, actually, in finance. And one of the classic cases of that actually is Robert Merton, who won the Nobel Prize in economics. But he had a really strong model that he was trading off of. And when the world started changing on him, he actually didn't appropriately update the model. Mm-hmm. So the model sort of became vacuum sealed, is the way that I would think about it. It was like hermetically sealed. But, we can see this with lots and lots of hedge funds, right? Like they're doing great. They have a particular strategy that they're trading. Maybe they've discovered a particular type of dislocation, or they're really great value investors, for example. And the world starts to change, and you can see that they don't change what they're doing along with it. Right. Well, that's very, very hard for us to do, no matter what we're in, finance or otherwise.
In many cases, because that's your reputation, that's what you're known for. Nobel Prize is a great example. I mean, that you're going to go to your grave with that thing most of the time. And again, we're generalizing here, but it's interesting that you mentioned Merton, or if you think about long-term capital management. One of my good friends, Jim Rickards, who you may know, he was the lawyer at that place, and he ends up now being this great observer of markets because he uses complexity theory, chaos theory, and he thinks stochastically, and he's just basically looking for a better way than what obviously didn't work. And for me, that's actually the whole point. After doing this for 21 years, you eventually learn more and more from your mistakes. And I kind of get to myself to this place where a lot of the things you teach in your book are very, I think they have to do with discipline. Let's just start with that. Do you think that what you teach, how to decide, the book itself, largely lends itself to people who do or do not have discipline? If you're an undisciplined person, emotional all over the place, do you even have an ability to fade your feelings to begin with?
It's such an interesting question. You do, but I think that I'll say, but let me put it this way. I'm like 68% that you do. That's about how certain I can get of that. I'm not sure I can get beyond that. But this is what I'll say. If I had to make an educated guess, everybody has a natural distribution of decision quality. And if we want to think about how much is emotion driving your decision, we could think about the distribution of that, right? So everybody's sort of got their own curve for here at the right tail is my best decisions where I'm calm and emotion isn't getting in the way and I'm really thinking it through and I'm being really deliberate. And here's my worst decisions over here where I'm just I'm drunk and just making life decisions. So we have some sort of normal distribution right now. I think that people come with different distributions, mm-hmm. sort of naturally, different temperaments. Obviously, your environment then shapes that a little bit as well. And I think that if people really realize, and obviously this takes a self-awareness to say, hey, maybe I'd like to improve my decision making, which some people never get to that step. but let's assume you've gotten to that step, that you can shift that a little bit, the distribution. So are you ever going to take somebody who's sort of naturally a very emotional decision maker, really gets a lot of kind of like ego boost from feeling like they're making all their decisions with their gut, like a boss or something, and whatnot, and shift them over to someone who is much more disciplined in their process and really trying to be informed, not just by data and thinking about base rates and what's true of the world in general, and how do I actually shift off of that, and how do I model the world appropriately, and then having modeled it, figure out what the appropriate, say, allocation decisions are given those models, because two people can look at literally the exact same model and come up with different allocation decisions, right? So am I going to be able to get that person all the way over there? Absolutely not. But from the quality of life standpoint for that individual, that maybe I've shifted just a little bit, I've gotten that distribution to shift right, that's like a humongous difference over time. Like that improvement, that little improvement is going to compound over time in terms of what their life is going to look like, because it's an expected value game.
Yeah, I mean, that to me, I mean, trying to teach people how to place their bets incrementally, like in terms of literal basis points of capital. And again, just incrementally making decisions as opposed to these all or none. All or none, by definition, if you're using a lot of money, is an emotional bet for a lot of people. But
I don't highly recommend those kinds of bets.
Exactly. Well, that's why in your first book, Thinking in Bets, I'm like, this is real life. I mean, this is exactly what I deal with every day, all my own baggage, everything. I get so many issues, Time Magazine would run out of titles. I mean, at the end of the day, it's like, this is the real thing. Now, let's talk a little bit about some of the things that you wrote about in your book, resulting. Because I think some of these things trigger an emotional person. I have a pre-market show, Annie, and it's basically like the queue, just like the queue is right now, questions get voted up or down. Almost 100% of the time, the number 1, 2, or 3 question has to do with what went wrong yesterday.
Mm-hmm. Yeah. So resulting actually has like all these ripple effects. So maybe we can dig into a place that normally I don't quite dig into. But let me just say, first of all, what resulting is. So when we talked before about like this high need for closure, being a more deterministic thinker, resulting kind of fits into that category a little bit. So there's a variety of different shortcuts that we'll take in cognition, some of which go into the category of like a substitution, where we're trying to make a judgment about one thing that's very complex, and we substitute in something that's more simple to judge. So an example of that type of substitution would be, let's say that I'm interviewing a candidate for a job, and the candidate is like really, really charismatic. That's a very easy thing for me to judge compared to the very complex decision of what is my forecast of how this person is going to actually perform in the role that I'm hiring them for. Mm-hmm. So what you'll see is that somebody will they'll rate the candidate highly, but what they're really doing is judging their charisma. Mm-hmm. Like that. So that's kind of a simple example. All right. So you can see that resulting is sort of this problem, right? If I were to take any type of decision and try to figure out what the quality of the decision itself was, that's incredibly complex. For example, with Thinking in Bets, I open it with this Pete Carroll play where he calls for a pass play instead of a run play.
I don't think any of the Seahawks fans remember that. Now, maybe you should remind them.
Not a single one of them. Right. So they're behind by 4. And everybody expects Bill Walsh to have the ball. Sorry, not Bill Walsh. Pete Carroll, to hand the ball off to Marshawn Lynch. And this is kind of the expected play. He actually decides to have Russell Wilson pass the ball. It gets intercepted by Malcolm Butler. That's the end of the game. And to this day, people are like, worst play in Super Bowl history. But the thing is that for me to actually go through what is the quality of that decision, it's super complex. It requires that you understand what the base rates are. You have to understand like what the probability of an interception in that situation is. Not just in general, but like when you're on the 1 yard line and the defense is, everybody's compressed, right? The field is compressed. What's the probability of a touchdown? What's the probability of a incomplete pass? Then you have to go over and what's the probability that Marshawn Lynch scores? There's obviously, fumbles and sacks in there. Then, interestingly enough, you also have to throw in some options theory. Weird, because one of the things that happens is that Pete Carroll has 3 possible plays, but a clock problem because he's only got 26 seconds left. So you're asking, like, what does he have to do in order to be able to get 3 plays off instead of 2? Mm-hmm. And then what's that option worth to get that 3rd play? And then given the choice that you make to be able to do it, which in this case is to pass the ball, what's the cost of that? And you have to sort of figure all that. Anyway, you can see this is very complicated.
Yeah.
But you know what's not complicated? The ball was intercepted. Mm-hmm. That is just simple as pie. So what people do is they'll look and they say, oh, well, the ball was intercepted. So that must have been a really terrible play, because it's an easier judgment to make. And the way that we can kind of tell that that's happening is that we just do a thought experiment really quickly and say, hey, imagine that was caught for the game-winning touchdown and the Seahawks vanquished the dreaded Patriots. Then what? And obviously, like, it takes 2 seconds to realize that is the most amazing play in all of Super Bowl history. And he's clearly going to go to the Hall of Fame because of it. So you can see that you're sort of, the way that you judge the quality of that decision completely flips. So that's why I love that one as a really good example of resulting, because you can see the substitution occurring. Now, one of the problems, though, with resulting, and this is what I heard you say, which I want to just sort of like latch onto, is that you said everybody wants to talk about the thing that went wrong yesterday. And notice that you didn't say everybody wants to talk about how they outperformed expectations yesterday. They want to talk about what went wrong. Yep. And this is actually a really big problem when we combine this with the resulting problem, which is that when we look at what is it that causes people to do deep dives into process, right? So when people want to know kind of what went wrong yesterday, they're generally smart enough to know that you should be asking, what did the decision process look like? What was the information that went into it? What were the forecasts that we made? What were the expected outcomes? If we were to do a distribution of those outcomes, where we're sitting on it, did we misidentify the risk? Like, people know you're supposed to say all those process words, but they're only actually diving into that process because something bad happened. Mm-hmm.
That makes sense. And when it comes to your own money and you're using somebody else's process, I guess that's part of my problem, is that I implicitly trust, the complexity that's behind this decision-making process, but I'm trying to get somebody to trust me. I'm trying to get an entire arena of fans to trust that Pete Carroll, because there were 26 seconds left, that was actually a good decision to make. And you say that you wrote this. It's I never forget it. It's like you want to align. Correct me if I'm wrong. The quality of the outcome with the quality of the decision-making process, and that quality of the decision-making process. That's where I spend like 99% of my time. Like, looking at the results, it's just like I have so many results. I have, somebody could check it up, but I mean, since 2008, when I founded this place, I have something like 5,000 real-time alerts timestamps. Like, so you have lots of outcomes, but if I didn't have a process, none of those outcomes, good or bad, would matter.
Well, that's exactly right. But then we also don't want that. We don't want the process to become hermetically sealed either, right? So we do want to be able to close those feedback loops, right? So the question is, how do you do that? How do you avoid both issues, right? This is my model of the world. I know it's correct, and outcomes don't really matter, so I'm not going to update my model of the world. Okay, so that's going too far the other way.
Yep.
We don't want to do that. But we also don't want to say, every time something bad happens, clearly we have to just change our decision process, because that means that our decision process was bad. Nor do we want to say just, something great happened, I outperformed the market because I put 80% of my money on some high volatility trade. And it worked out, and now I'm rich. So I'm going to keep doing that. And whenever I have really strong conviction, I'm just going to put 80% of my money on something. That's a pretty good way to go broke. Okay, so we don't want to live in either of those two extremes. So the question is, how do we actually marry those two? And the answer is to not do the thing that we naturally do, which is to dig into process when we have bad outcomes. Because that actually is reinforcing for people that they better watch out for bad outcomes, and you probably shouldn't innovate, and you should probably play like mini-max strategies so that you don't get in a room having to defend your process. And it's also not great for learning, because it's just reinforcing try to avoid bad outcomes, and that's not going to create great decision making. Instead, what you want to do to actually be able to close these loops appropriately is to essentially set a band within which you'll tolerate an outcome, either good or bad, on either side of the equation, right? So I make a forecast and I'm going to set some confidence interval around that. And if an outcome lands within that confidence interval, I don't care. But as soon as it's outside of that interval, that's on the downside or the upside.
Yep.
Then I'm going to dive into process. Now, why do you want to have that two-sided look at things? Well, because you should care, first of all, about accuracy. And if you're way under, that's just as inaccurate as if you're way over, right? And we only tend to look at the one side. Number two, you should care about under allocation as well as over allocation. So when we only look at things that end up on the unexpectedly on the downside, we're examining possible over allocation problems. But we're not looking at things that are unexpectedly good, which could be a possible under allocation problem. And then in either case, if you're outside that band, it means there is something wrong with you. There's possibly something wrong with your forecast. It is not always true.
Right.
You could just be 2 standard deviations away from the mean, and we know that's going to happen some percentage of the time, right? But it is possible, for example, that you underestimated the amount of risk, as an example, that was in the trade. Or it could be that the reason that you thought that you were, like your thesis for why you were putting the trade on, it turns out that the reason you won had nothing to do with that. And you should want to know that. So we want to be looking at both sides of the equation. And then what that reinforces to people is that you actually do care about process.
Right.
Because part of the problem is if you tell people all the time, I just really care about process, I really care about process, but you only dig into the process when you get a bad outcome, what your actions are saying is, oh, by the way, whatever I say, I actually really care about the outcomes.
Yeah.
Right. I don't know if that makes sense, but what people tend to do is like, they put a trade on, it wins like some unexpectedly ridiculous number, and nobody seems to be alarmed. Everybody's having champagne.
It's so true.
Right? Everybody's like, this is awesome.
It's called luck. I mean, so, you never want to confuse luck with a good process. I mean, it's
No.
Yeah. And I think I'm basically the opposite. I'm rightly accused of being a bit prickly when people are just resulting on something that, to me, I'm like, I don't care if I won or lost there yesterday. I'm trying to deliver on the process today because that's what's going to determine the outcomes in the future. And I actually am quite dismissive of it, but at the same time, I have to teach it, or these people aren't going to subscribe to the thing, right? So, so it's kind of like that. I mean, the way I've actually, it's fascinating to have you on a live wire here, because when you explain these things, it stress tests like how I've thought about constructing not only the decision-making process, but the sizing, the timing, the max bets, the max bet by asset allocation, by stock pick, which are different. Like, to me, that's how I get my expectations bounds around what could, should, or would happen. Like, if my max position in a stock is 3%, that's what it is. I mean, if it goes up 100% tomorrow, I got lucky. That's not what I was expecting. But if I put 30% of my capital in one stock because I thought it was a good pick, that's stupid, and it's not part of my process. So that's what I try to do. I also put a risk range, a daily risk range around each thing that subscribers look at, like gold or the 10-year bond yield or the S&P 500, just to make it simple, because then it gives them okay, what's the upside today, like now? It's an instantaneous volatility signal, basically, which is stochastically built. That's the way you build it.
Right.
So it's like, here's the upside today, here's the downside, and if it's below the downside, even better. You buy more, and if it's above the upside, well, you got lucky, sell more. So that's how what do you think about that? That's what I do.
Yeah, so you're doing exactly this. You're saying I'm neutral to whether I won or lost. It's whether it's performing within what my expectations of this are.
Exactly.
So and that's really what you should care about. And the reason that you should really care about that is that any single decision that you make this in anything is a prediction about the future. Even if it's just like, what route are you supposed to take to work? That's a prediction about the future.
Yeah. Right?
Now, at work, like if you're 10 minutes late, it's probably not a big deal. So that's okay. So you don't need to necessarily run like a really specific process for like, what route should I take to work, unless you have a really important meeting, and then you'll probably step back and think about it. Something that you can't be late for. But this is what we need to understand, is that they are predictions of the future. We ought to be writing those down. We ought to be recording what do we think the upper bound and the lower bound is. We ought to be saying in advance, if certain things happen, I'm going to go back in and I'm going to re-examine what my assumptions were. And I'm going to check to see, because this seems to be quite unexpected. Now, when you're talking about how do you actually teach this to other people, this is one of the best ways to teach other people why the process itself is what matters. Well, I think that one of the problems we have is that we preach process, and here's what a good process looks like. But then somebody's in a room having had a bad outcome and they're having to defend themselves. And then they have a great outcome that's equally unexpected, and they're being taken out to dinner with champagne. So how on earth is that communicating to them that the thing that you're saying, that process really matters, is what actually matters to you?
Yeah, it's not like again, it's not, and that's why in my world at least, like I'm comfortable in saying I go both ways and I like it. Like I literally. In markets, I don't care which way I'm going. I mean, for 2 years I'll be long gold, and now I'm short gold. Good example of that. And it really has nothing to do with like being right on the upside or the downside. It's actually being accurate in terms of the full investing cycle of gold. And it's like I'm just using an example. Another thing though that I struggle with, and it's a real. I mean, I'm basically you're literally like my shrink here for this hour. It's like another thing I definitely struggle with. Resulting, because that forces me into a place where I'm not getting to where I actually want to go, but I have to go there. The other thing that I struggle with is the theories on how I'm wrong or how we're wrong collectively as a group in this case, and there's a lot of it. The stuff we don't know, the stuff we think we know. There's a whole industry on Wall Street of scaring the shit out of people with things that could be right that have a very low probability and a falling probability at that. Like that's a frustration of mine, that I have to actually refute other people's talking points on what they think they know, which is actually, like I said, a low probability event that just got data that said it's actually falling even further.
Yeah, I mean, these communication issues are difficult to tackle. And I think that one of the instincts that we have as humans is to tell people what the truth is, in the sense of to represent to them that we know for sure, right? So like in the situation that you're talking about, to say, no, that's wrong, and I know better, and sort of leave it at that, right? And what I think is interesting is that it's actually a lot better to get the people that you're communicating to involved in what your process is, and to actually communicate it as you know it.
Yeah.
So I think there's X probability of this happening here. Here's the reason why. This is what I think is true of the world right now that makes me think this. This is why I think it's this probability, because I'm looking at the past base rates or generally what these cycles look like. But if this other thing happens, which I think there's, say a 23% chance that actually I should be modeling this differently. These are the instruments, or these are the investments that would perform well under that. I totally recognize that. And so I'm making some small bets against myself for that reason, which we would call hedges, in order to protect myself against that. And I'm distributing those bets across the probabilities that I think that those things are actually ground truth.
Right.
So a lot of people say, oh no, if I communicate that to someone, then they're going to think that I'm wishy-washy and I don't actually know what I'm talking about. And they're going to go off to somebody else who's telling them for sure. And I think it's actually quite the opposite.
The opposite, for sure.
That people then actually, you seem more thoughtful, you have more credibility, and then you also get the added bonus of you've set their expectations really well. Because you've set them to what the actual world is. And they understand why you're doing what you're doing, and why you're sizing the bets the way that you are, and why you're sometimes it looks like you're betting against yourself, which you have to explain, and so on and so forth. And I just think that essentially, a more open kimono kind of approach is always going to be better.
That's actually, again, that's exactly what happened to me in June of this past year. The world's going one way. I thought it was going the other way, and then I just opened it wide open. This is what I'm doing, why I'm doing it, what my incremental bets are, what my max bets are, and then all of a sudden, when people could see the entire picture, they started calling me coach, I think, literally.
Right.
And it was us more together, coach and players, as opposed to me making a big call, and because
exactly.
that's what people on Wall Street want. That's what they beg for certainty. And you're right. Even the show Billions is like, how certain are you? Very. It's like
right. Which, by the way, is so horrifying to me. Like, what does very mean? I don't even. That could be interpreted many different ways. But yeah, I think that. I think it's a little bit of an interplay, right? Like, people want to be told for sure what the future is going to be. But then also, the people who are communicating those things, I think that we intuitively think that will make us more believable. It will make us more commanding.
I think it makes you less believable. I mean, that's actually
exactly.
what I fight against every day. And I actually have my real frustration with myself on this is I get not just frustrated with what you would call the outside view, but an irrelevant outside view. I just dismiss it. Like, my outside view to me is the market. Like, truth is price, volume, volatility, how I build it. I'm sure you don't want to get into that. But the outside view to me is quite literally 50 different countries interacting in a fractal economic system that's nonlinear, and every day I have no idea what's going to happen. That's my outside view. My inside view is my position, and I'm constantly fighting, not fighting, but I'm trying to get to the truth that the market's going to be right or wrong. Not some group of people that have been put up in some elitist tower that are ordained with talking points that I don't even care about. Like, is that too dismissive from my perspective?
I would say so. What I would say is that you want to be a little bit in between those two things. So let me explain what I mean. Let me explain what I mean by that. So first of all, I totally agree with you that the market itself is the outside view, right? Because you can look, if I'm making any kind of prediction, I want to know what the historical behavior of the thing that I'm predicting is.
Yeah.
It's like super important to me to know that.
Yeah.
Right. So, and if I have no knowledge whatsoever, I'm going to predict the historical behavior of the thing that I am trying to predict.
Mm-hmm.
That will be my prediction. And I will do better than a lot of people by just saying, I'm going to start with ignorance, and I'm just going to look at what historically has happened. And that's the thing I'm going to predict. And we know that you'll do better than most people, because if retail investors did that, they would be richer. We know that.
Yeah.
Because if I'm coming from a state of ignorance, I just say, oh, the market just goes up, and I should never really take my money out of it. And I should just invest passively across a well-diversified whatever, like an index. I should index my money, and I should have some proportion depending on my risk attitudes. And then I should just leave it there and not pretend I know anything. And we know that if I were to do that, I would do better than almost any retail investor. So that's why we know that outside view is so incredibly important. That's just, as you said, that's what the market is. Mm-hmm. But there's another thing that's part of the outside view. And the outside view is the way that other people model the thing you're looking at. Now, the thing I want to be clear about is that while that's the part of the outside view is how anybody looks at the thing that you're looking at, that does not mean that you should care what anybody thinks.
Exactly.
Because some people's opinions are of higher quality than other people's opinions. So it is actually important, though, to when you're looking at that data and that historical behavior, mm-hmm. and you're trying to think about what the causal drivers of that historical behavior are, which is where obviously you generate alpha from, you would like to get more than one person to look at it. So you do want to get some other eyes on it. And the key is that if you really want them to challenge your thinking in a way that's going to be really helpful, is to not tell them what you think about it mm-hmm. first.
Yeah, I love that. I love that. I mean, that's literally on this page at the back here on having good hygiene, as you'd said. It's perfect for
that's
this.
That's right. So I don't want to take somebody off the street and say, hey, let me show you all of my data that, where I'm modeling the market in order to make predictions, and tell me what you think. Obviously, that's useless. And I certainly don't want to take people who have interests that aren't aligned with mine either, which would be like people on television who are just saying stuff.
Yeah.
Right.
Yeah.
I don't really want to listen to them, but I would like to have some very smart people look at the data that I'm looking at, tell me what they think that my allocation should look like. I separately go and say, I'm looking at the same data. And obviously you have to communicate things like this is how much risk we're willing to take on. And, because that's different for different people, but I'm assuming that you've given them those facts as well. I'm going to say, please tell me what your allocation would be. I'm going to go over here and I'm going to say, here's how I would allocate my capital. And then I'm going to look at them and I'm going to see where there's dispersion between those two.
Yeah.
And what I'm going to do is just dig in on that dispersion.
Mm-hmm. Yeah,
and obviously it's going to increase my confidence on the areas where we overlap in a way that normally when you're discussing it as a group, like in a group setting, when two people agree, you increase your confidence, but that's bad because you've talked about it in a group setting. It's not actually a good signal. But if both of us have gone off on our own, looked at the exact same data and said, and agreed on a particular allocation decision, then you should actually increase your confidence in that allocation decision.
Yeah, now that's the outside view that I appreciate and respect and engage in all day long, but it's privately, right? So if and it's not like I'm having discussions with him today, but Stan Druckenmiller's, because he's retired. But if you were to have Stan Druckenmiller, Rick Reed, or Ray Dalio, you have people that actually have proven process over a long period of time in macro, as a subject matter.
Yeah, so those views really matter. So the thing about the outside view is that we want to define it pretty narrowly as not our view, basically, right? So we have particular beliefs. We have a history of making decisions that we're endowed to. As you hinted at before, our identity gets wrapped up into those decisions. So as an example, if I have an identity as a value investor, it's very hard for me to let go of that identity. Right? Because what does that mean for all the decisions that I made in the past and who I am and how people perceive me, and gets into a whole bunch of sort of, cognitive dissonance, and you end up generally committing further. So what you'll say is, I know it's going to come back, or I'm going to stick, whatever. So that's the problem. That's the problem with the inside view, is that we have strong models of the world, and we have beliefs that we're really constantly trying to sort of square and justify and make sure that we have a consistent through line in terms of our identity, and that we're able to make positive updates to that through line as well, right? So what we want to do is get to a point of view that is outside of ourselves.
Right.
That is not to say that every point of view is better than ours, and one that we should be paying a lot of attention to. In the same way that part of the outside view is data, and we know some data is really crappy. Mm-hmm. And so we need to have some way to actually understand what data is high quality and what data isn't, in a way where we can separate that from us just liking the data, right? Which would be a different thing. And that's part of the reason why you want to get different eyes on it, because they'll have different opinions on what's quality data and what isn't, or what you should take from it, or how you should model it, or what the allocations decision should be, even if you agree on the model.
Yeah, taking this all the way back, and by the way, we're going to go to other people's questions next. I mean, taking this back to the beginning, I know if you're not modeling it stochastically and you're modeling it deterministically, I have a lot less time to listen to your opinion. If you're modeling it the way that I do and embrace uncertainty, and you have a different outcome that you're predicting or forecasting or positioning for, and you're Stan Druckenmiller, well, my ears are right perked open, and I want to hear specifically what you're saying about that. And what the data is saying about that that's leading you to that conclusion. So I want to make that clear. It's a lot different than listening to, I don't need to name names,
a talking head on television or something.
I would never go there.
But that's what I'm saying. That's why I'm saying, you want to kind of live in the middle. You want to pick your spots.
Yeah.
Right? And that's true. That's true of any decision. It's if you have a hiring decision, you want to get the people who it would make sense that you would want their opinion on who to hire.
Right. 100%.
So, I mean, that's just an important thing. The thing that you don't want to do, though, and this is actually really important, is to exclude voices who aren't subject matter experts.
Right.
So, what I mean by that is try to find the really smart people who might have a kind of interesting view on the situation. So you can see this in Simon's work, right? Mm-hmm. Where you basically say, hey, you're really smart and you kind of understand biological systems. I think there might be some overlap. I'd like you to take a look at this other system.
In fact, that's if I look at the last decade of what I built, it largely relies on the stochastic discipline in other fields. I mean, that's how we learn. I mean, it's not, and actually I'm quite surprised that in finance and on Wall Street in particular, they're the last to embrace it. And I think it largely has to do with the bias that you said, which is, if you're Irish Spring at Procter & Gamble, you certainly can't take the Irish out of me, and you can't take the Irish and the Spring out of that box. That's what it is. That's how it's marketed. It's not marketed as olive oil. So when you're a value person, you're a Bitcoin maxi, and that's why in this day and age, my own opinion on this is that the evangelism that's born out of Twitter and everything else is people really they want that person who's evangelizing on the directionally the only way that your belief system can go. And that's created a lot of opportunity, actually, as you might imagine, for investors. So here's a good, so I'll just get into the questions here. These questions have a central tendency to be good. The probability is high that these are good.
Well, that's good. I'm happy for that.
Okay, this is, and we have a global audience, and this question, not surprisingly, is from a Norwegian by the name of Sven, who lives in Washington, D.C. The best processes will eventually result in a losing streak and could increase the urge to take on higher risk, as those bets, go down. What strategies do you use to reset the brain when everything goes against you during and after the game?
Yeah, that's a really good question. So way back when, for people who are familiar with Kahneman and Tversky and prospect theory, this was really one of the original findings, was that when you're what's called in the losses, meaning that you've had a losing streak, we tend to seek out volatility. And in fact, we'll seek out the appropriate volatility in order to be able to get our losses back. So this becomes more problematic as you lose more. You can do that calculation pretty quickly. So what do I mean, like seek out the appropriate volatility? It's like if you're losing in a poker game, anytime that you have a choice, and this is true in investing obviously as well. I have a choice I can make, like I can take a lower volatility line of play or a higher volatility line of play. Like I have some control over that, how much I'm putting at risk, and how swingy it's going to be. And if I'm losing, I'll tend to go to the swingier choice, because the swingier choice is what has the branch of the tree that gets me even.
Asymmetric.
And the less swingy, the lower volatility choice doesn't actually open up that line for me, right? And then if there's not enough money for me to turn like through the poker game that I'm playing in to get even, I never did this, but some people will go and like play craps.
Yeah. And really
you bet whatever you want there, and so you can get even. So this is actually a really big problem. So here's kind of the finding in cognitive science. This is actually part of what I'm writing about in my next book. So I really appreciate the question. Is trying to solve it in the moment is really hard. Now, the more process focused you are, over outcome focused you are, the better you'll do with this. But it's just really hard to sort of say, I'm just going to step back and like in this moment, I'm going to make a great decision because I understand this is a problem, and I know that my decisions about what my risk attitude is going to be really distorted when I'm losing, and so I'm going to take that into account and make a great decision. That's not happening. So the way there's kind of there's essentially kind of three ways to handle it. One is really strict, which is just to set in place like loss limits, and then to say, then you can sort of pile on top of that and say, I'm going to set a loss limit, and then on top of that, if I have a certain number of days in a row where I've lost, I'm going to take a break. And you set those things in advance. That just allows you to go and have like a mental break so that you can come back fresh. And basically what you're saying is, it may be the case that I'm getting unlucky. That could be the case. But what I also recognize is that when I'm in a state of losing, I'm going to be a very bad judge of that.
Yep. That's
I'm just going to decide in advance that I'm going to take that decision away from myself. Okay, so that's one thing. That's just a Ulysses contract. The second thing you can do is find someone, and I'm quoting Danny Kahneman here, find someone who totally loves you but doesn't care about your feelings. So what does that mean? Somebody who wants the best for you, but they're not worried about making you feel good about yourself. In the sense of being like, oh, I can't believe you've been getting so unlucky. You're right. Like, you should keep betting because you're obviously so much smarter than everybody else. That's like the worst thing. You need someone who can actually see your situation pretty clearly and make better decisions about what you should do next than you will in that situation, because you're obviously not, you're compromised in terms of your decision quality in that moment. And so that's really helpful. So that sort of tap on the shoulder and say, hey, you should take a break, or you should keep going. You shouldn't take this position off even though you've been losing, because it's actually a pretty good one. You should take it off even though you've been winning, because I actually think you're out of your mind. You're really lucky and you've just been trying to get even, whatever it is. And then the third thing you can do, and I think this is as you get more sophisticated, is you can essentially get kind of an interaction between these things, which is to say, in advance, once I put the position on, let me think in advance about what the conditions are that would be occurring in the world under which I would take the position off, under which I would ratchet it down, under which I would actually put more money into it, right? So that's just essentially saying, like, there's lots of different ways that the world could turn out. Some of them are going to bode better for me. Some of them are going to bode worse. Some of them are going to be things that are going to tell me that my thesis was actually not even right in the first place. And I should actually have my eye on those and make sure that I've got plans of action for when those things start to unfold, and that I've actually identified what the early signals are that tell me which branch I'm going down. So this is sort of to your point that we started with, right? The world isn't deterministic. There are lots of different branches that it could take. And so identify what you think those possible branches are, and think about, if I have a signal that I'm on this particular branch, what am I going to do?
Yeah.
And write that down in advance, and do that for any of the branches that you identify. And then also just have a separate category for what's going to tell me that there's some branch that I didn't even know existed.
Yeah.
Right. And then I'm going to just take the position off because I clearly don't understand the world right now. Right. And then you could do that. So, but you hear it's all like, do it as advanced work, or have somebody from the outside looking in help you with it.
Well, the outside, I do a lot of that one-on-one with other portfolio managers, and you'd be amazed the different kinds of discussions. And I'm not going to go off on and on, but one of them is, you just rattled off a whole bunch of lessons. One is just get it off your screen, dude. Like it's just like you're stressed about it every time I talk to you. Just take it off, take a break. Or the other one is one hedge fund manager in particular. He always says, okay, good point. Let's talk about a post game. That's an intra game. Like if the market's still trading, because I'll ask him, well, why did you do that? Why did you size that? Why did you do this? And he's very good at ordering the questions on what could improve his process versus what's happening, right here in the now. So there's a lot there, Annie. Thank you for that. I want to make sure I get some of these other questions in. This is actually a very interesting observation from John. He said, Annie, given the books on your bookshelf, I'm assuming the ones that are behind you, are sorted by color, not topic. I'm assuming you prefer to think visually. But now that's his assumption. You can refute that if you want. What visual tools would you recommend for improving your decision-making process?
Oh, that's really interesting. Yeah, so actually that's a good assumption. I remember books by their color, which is why they are sorted this way. It's not like some weird decorating thing, because you can see that I've got blue on the top shelf and on the bottom shelf.
I wasn't going to say it.
Well, it's not, because I just sort of like, as I was putting books on the shelf, I was just clumping them together because I just care about being able to see the color of the book. Not only that, if you're asking me for something that was in a book, I'll tell you generally where it was sitting on the page.
Yeah.
And how far into the book it was. And if I tell you a hand that I played in like 1995, I'm looking at the table.
Yeah.
Like I'm actually watching it. I'm like reciting sort of a video that's playing in my mind. So here's the deal. I'm a huge fan of dashboards. I love them. Now, what dashboards you respond to, what dashboards sort of intuitively allow you to process that data in a way that you can do it really fast. That's going to be user specific. Not everybody likes the exact same dashboard, but you should fool around with different dashboards for data visualization. And you can do this obviously for seeing, understanding risk and, anything that you need, and figure out what dashboards kind of work for you, and then get someone to create them.
Yeah.
It's like the best investment that you're ever going to make. And it also helps you with that sort of what you're talking about, sort of feedback loops, because if you sort of can remember what those dashboards look like, you can, first of all, you can scroll through them historically, which is really nice. But even when you're not in front of them, you can then sort of scroll through in your head, like, what did those dashboards look like? Like, how did they evolve?
Yeah.
And I'm just a huge fan. Like, pretty much every company that I work with, we develop dashboards. It's like one of the first things we do. And they're not the same for every single client that I'm working with, because different people like it to be visualized in different ways.
Yeah, there's nothing more valuable to me in a decision-making process than a dashboard with the time series on it. If I don't have that, I'm just unaware. I mean, I could tell myself whatever story I want. It's irrelevant unless we have an actual account of what happened. So that's
exactly right.
That's very.
And what you like is different. Like there's some types of problems, for example, where, like, I'm a huge fan of histograms.
Yeah.
And it's just like histograms let you see the differences between things, like, so easily. It's like, look, ooh, big, oh, that's a drop, right? And obviously that's different than, obviously it depends on what the x-axis is, like how big the difference actually is, and you need to know that. But I just think visually, like, it's very powerful for me personally. That doesn't mean that that's the best way for it to be visualized for you.
No, 100%. I mean, that's why fractals are so powerful. I mean, when we're talking about intense, geometry from a mathematical perspective, and people, they can quickly say, oh wow, I understand the edges of a leaf for the contour of an ocean line. That makes more sense now. Multiple factors, nonlinear functions. So I think we're really on the cusp of a lot of good things in this world from a decision-making process, particularly in markets. This question, and we only have time, I think, for this last one. Max Runkle, how do you look, Annie, at asymmetric payouts in a known or unknown probability?
Oh, that's a really interesting question. Yeah. So, obviously, it depends a little bit on what you know versus what you don't know, right? So, if you have perfect information, you're just looking for limited downside and a lot of upside, right? Yep. And then, and that becomes an issue about how many bets do you have on, right? So you just need to deal with the fact that there's an asymmetry there, and particularly once you get into power law, you just need to have enough. You have to have enough at bats, right? That's it. Mm-hmm. But the thing is that obviously you don't always know. So some of the way that you can handle that is by de-risking, by essentially increasing the size of your portfolio. Yep. In other words, how many bets do you have? So the less information that you have, generally, the more bets that you want to put on. The second thing is that sometimes there's an asymmetry in your knowledge. So you can have a lot of information about one side of the equation, but not very much information about the other. At which point that would cause you to either put the bet on or not. So it's weird. Like a real world example of this is a strange one, is wearing masks. Mm-hmm. We actually have like a lot of information about the downside of wearing masks, because people have been wearing them to like do surgery on people for a really long time. So they've been using it for a different purpose. And they all seem to have lived through it just fine. So the downside of masks are limited to nothing. But now we're starting to understand it better. But certainly way back when in the spring, we didn't necessarily understand what the upside of masks were. And what I heard from a lot of people was, well, then we oughtn't to use them because we don't actually know if they do any good. And the answer is like, but you don't need to know if they do any good. Because there's no downside. So you only have upside. And so I love those kinds of bets where essentially I'll start to experiment with that, partly because that also helps you to get the information about the upside you need. So where I get obsessed in that asymmetry is really trying to learn as much as I can about what the downside risk is. And while I would like to know what the upside potential is, it's less important to know when you actually start to bet on it. Mm-hmm. So you can bet with less certainty when you have more knowledge about that there's limited downside. And then those bets can actually help you accumulate the knowledge you need in order to understand whether you should be putting more on that position. I hope that makes sense.
It makes to me it makes 100% sense. Now, my goal after this conversation, and thank you for having it, is to be able to coach some of these points like a little bit more patiently. I'm going to be more patient. And again, visually, I think that that's going to be a helpful thing. Like what you just said, by the way, on diversifying, particularly if you're someone like me, a global macro person, by definition, I can bet on 50 different countries across all major asset classes. I can have tons of bets on the table, but when you really, put something on is when it comes to you. Like those bets, they don't just, you don't make them come to you, they come to you. And that's, I think, something that's also just associated with embracing the uncertainty of it all. So, thank you. I got to think, again, I listened to your book as well, Thinking in Bets, because you read it. I'm pretty sure you read it.
I did.
Yeah,
I did read it.
Because I've had this voice in my ear before. I'm pretty good at listening. And
you've had it. Yeah, you probably had it in your ear twice, because I've actually read all my books.
No, I like to read a book and then listen to the book and then go back and dog ear like what I thought I heard and then test myself a bit. So you've done as good a job as anybody with me on that. So thanks for coaching me. I think your names appeared in more early looks than anybody going back to 2018 when you wrote that book. And I hope everyone just absolutely take this, particularly How to Decide. And I think Annie just gave us like a whole bunch of previews of her upcoming book.
I did.
I know you did.
Because I'm thinking about it right now.
I think Sven got it out of you. So nice job, Sven. And and thank you so much. Appreciate it.
Thank you so much.
She's Annie Duke. Just awesome. Just awesome. People in this world are awesome. You just got to find them. Thanks.